In this chapter, Phil Town gives you the hard evidence behind the wonderful business idea. 5 numbers you must check to know a company is predictable and worth owning. He calls them the Big Five. If these 5 measures look healthy and consistent, you can more confidently price the business and follow rule number 1. Don't lose money. The most important Big Five is ROIC, return on invested capital. ROIC tells you how well a company turns the money invested in its operations into profit. Example, a ROIC of 20% means that for every $100 the company has invested in its operations, it generates $20 of profit annually on that capital. Town's rule of thumb: a healthy business should average at least 10% ROIC over the past 10 years. If ROIC is weak or declining, move on. A wide moat, a sustainable advantage, usually shows up first in a strong ROIC because the company isn't being forced into constant price competition. The other 4 Big Five elements are growth rates: sales growth, earnings per share, EPS growth, equity, book value growth, and free cash growth. Again, Town wants averages of 10% per year over 10 years as a baseline. Why growth rates? Because they're clues about how the business will perform in the future, and future profit drives the value of the business today. A few practical points about each number. Sales growth is the top-line measure. Are people still buying the product or service? EPS growth shows how profits available to owners are changing per share. If EPS lags while sales surge, something is wrong. Equity growth, book value per share, measures the company's accumulated surplus. Equity is what's left for owners after a company sells everything and pays its debts. It's the company's net worth on the balance sheet. It's a proxy for the long-term growth of intrinsic value. Buffett uses it for Berkshire. A growing equity is a very good sign. Free cash growth shows whether profit is turning into real cash that can be used to grow the business or return to owners. Profits on paper that don't become cash are suspicious. Town emphasizes consistency. Don't be seduced by a single great year. Look at the 10-year average, then the 5-year and 1-year figures to spot trends. Ideally, the numbers are above 10% and stable or improving from 10 to 5 to 1 years. If they tumble in the recent year, dig in and learn why. He illustrates this with side-by-side company comparisons. Dell versus Gateway is a classic. Dell shows very strong ROIC and healthy growth rates. Gateway shows negative, collapsing numbers. The data makes the choice obvious. Town repeats that ROIC is the first number to check. If a business doesn't earn attractive returns on capital, the other numbers won't make it a safe investment. He also warns that some industries have naturally low margins, so context matters. Compare companies to their peers, not to unrelated businesses. Debt is an important follow-up, though Town treats it as an afterthought. He doesn't want debt ignored, but he prefers a simple, practical test. Take total long-term debt and divide it by current free cash flow. If a company could pay off its long-term debt in 3 years or less from free cash flow, the debt is acceptable. If it would take longer, the company becomes risky, too dependent on future conditions. Zero debt is ideal, but manageable. Short payoff time is what matters. Town also explains practical data sources. You don't need a PhD or expensive services to get started. Free financial sites, e.g., MSN Money, Yahoo Finance, provide years of sales, EPS, and book value data. Some sites calculate parts of the Big Five for you. He points out that professionals pay for cleaner, organized data because time is money, but as a rule number 1 investor, you can do 90% of the work with freely available figures and a simple calculator. A couple of important nuances. Buybacks. When management repurchases shares using free cash, it increases your ownership of the business. If buybacks happen when the stock is cheap, that's shareholder-friendly. If they occur when the stock is overpriced, it's a waste. You must judge whether buybacks were done wisely. And the Big Five help with that judgment. Dividends. Paying a dividend is not inherently good or bad. It simply reflects management's decision about whether they can use cash profitably. If they can't reinvest at high ROIC, returning cash to owners is reasonable. But dividends are taxed, often heavily, so their presence or absence shouldn't be a deal breaker for rule number 1 investors. Town closes the chapter by showing how the rule would have performed in the year 2000 on a few names: Harley, GM, Dell, and Apollo. The rule identified Harley and Apollo as buys. GM and Dell were priced too high then and were poor choices for rule number 1 investors. The lesson: analyst expectations can be wildly wrong. The Big Five and valuation discipline protect you from being seduced by optimistic forecasts. Bottom line, the Big Five give you a simple, objective way to test whether a business is predictable and owner-friendly. Check ROIC first, then the 4 growth rates, and finally the debt payoff time. If the numbers meet the standards, consistent, preferably above 10% over 10 years, you have a candidate worth valuing. If not, move on. This disciplined, numbers-first approach turns vague hope into reasoned probability. And that's how rule number 1 investors avoid losing money.